Hello there. So this is just a recap of everything we've done on the course so far, which is the first 10 videos that you can watch singly. So this is return on capital employed, the number one ratio. It shows you how much profit that you're making from how much has been invested in the business. Got a quick example here. If you go from -5% to 29%, that tells a story that the business is now doing really, really well. There's obviously a slight liquidity problem here because the ratio should be 2 to 1 and it's 0.81 to here. It's improved from 1 to 1. However, there is a liquidity problem and the net assets have also gone up from 1 million to 2 million, which means that the business is now worth at least 2 million quid. Okay, so all these numbers here will tell us a story. When you get a 20 mark question on here, you go through the numbers, then you use the market information, and then you make a definite decision on the 20 marker. Okay, return on capital employed. And then we moved on to an income statement, which is just sales, direct costs, gross profit, fixed costs, operating profit. And you get the gross profit margin and the operating profit margin. The one thing that doesn't tell you about liquidity or cash flow. Is simply about profits or the financial net worth of a business. Two ratios here, gross profit margin and operating profit margin, which could well come up. Third one here is a balance sheet on all the way down here. So we have non-current assets, current liabilities, non-current liabilities, net assets. So this business is worth 1.5 million. Three things the balance sheet will tell us: net worth, liquidity, and gearing. So on this one here, that they could give us this one here, we wouldn't have any numbers out here, but we can tell that the current ratio is 0.5 to 1, 100,000 divided by 200,000. The working capital is also minus 100,000 here because it's current assets minus current liabilities. And we can also do the asset test ratio, which is 50,000 divided by 200,000 pounds on here. Okay, but a balance sheet will show us that, but it will not show us the profit a business is making. So then we get an example of an income statement. What can you tell from it? In this case, obviously the revenue's gone down. Why has the revenue gone down? We would expect cost of sales to also fall because you are getting less revenue in. But also the good news is that expenses have fallen quite considerably. So that will increase your profits. But overall, because of the fall in revenue, our profits have gone down, and that is significant information. One advantage of an income statement is here you might want a bank loan. One disadvantage or loss of disadvantage of an income statement is not a balance sheet. It won't tell us the net worth of the company. It won't tell us about the liquidity of the company, and also won't tell us about the gearing of the company. But it will tell us how much profit we're making, and it will tell us, in this case, whether or not we can service a loan or not. Okay, there are 10 ratios in total. Gross profit margin, operating profit margin, ROIC, current ratio, asset test ratio, gearing. These ones are the big three. These ones here will all be percentages. And then we have 4 activity ratios. Stock turnover, the higher the number, the better. Trade debtors is how long it takes someone to pay you. Trade payables is how long it takes you to pay someone else. And asset turnover is how hard you are working your fixed assets. In fact, it is sales revenue divided by assets. Okay, this is a balance sheet. You've seen this one before. This is Debbie's balance sheet. She wants to buy this business. They've been told that she's got to buy it for 88,000 quid, but the business is only worth 52,000 quid. The problem with this balance sheet is we have no idea what the profitability of the company is. Quite clearly, if the company is making profit, say 50 grand a year, then 50 grand plus 52 grand a year, then this is quite a good buy. But we don't know that. So we've got the usual current assets, the non-current assets, the fixed assets, or capital expenditure, 25,000 quid. We can very quickly tell from here that the current assets are almost twice as big as the trade payables. In fact, if you work it out, 56,000 divided by 29,000 is 1.94 to 1. Your current ratio looks excellent. But once you do the asset test ratio, remember, which excludes stock, is 6,000 divided by 29,000, which is 0.2 to 1. Okay, so then that would suggest it should be 1 to 1, suggests there's a big liquidity issue going on there. Then we did a cash flow. Key line here is the bottom line here. Here we need to borrow money. Can we solve this problem? In this case, we could do. Read the case study. Customers are taking 60 days to pay, which is creating a cash flow problem here. because it takes them 60 days to pay. Then we're not getting the money in until May, when it should be coming in March. That is creating a cash flow issue. You do a cash flow statement because you want to bring money into the, you want to go and ask the bank manager if you can borrow money or not. Then we moved on to another cash flow. In this one here, the problem was Kareem wanted to go out and buy a piece of equipment. Plus they were spending more money on raw materials. This was creating a cash flow problem, cash deficit. How can you overcome the problem? Quite easy. You can either lease this machine, which will mean you're not spending 24,000 quid here. If you're not doing that, instead of being minus 11,000 here, this is going to be plus 13,000 roughly. So then we either need to lease the machine, buy it on hire purchase, or even get a loan to overcome the cash flow problem. Okay, another cash flow done one there. We move over to here, and we get variance analysis, dead easy, budget, actual, compare the two figures, favourable or adverse. Adverse when it leads to a decrease in profits, favourable when it leads to an increase in profits. Okay, so the revenue's gone up, that is favourable. Cost of sales has gone up, that's adverse. Gross profit's gone up, that's favourable. Expenses have gone up, that is adverse, but overall the profit's gone up, so that is favourable. And then we can analyse that to say, well, why have the actual expenses gone up? We can analyse that and say, well, why has the cost of sales gone up? The cost of sales may well have gone up because the revenue's also gone up. Okay, so that's pretty easy on there. Businesses will need to do a profit budget and a cash budget so they can show the bank manager that they may need to borrow money, so please lend us some money, please. These are the different types of organisational type of business. Sole trader, private limited, sell shares. A PLC can sell shares. The advantage of selling shares is you can raise money. It's the investor who takes the risk. The disadvantage is that they will take some of your profits. Partnerships and private limited are ways of getting more expertise into the business. However, the partnership, you have unlimited liability, which means you can lose everything, including your house. And then you have a limited liability partnerships. There's also a community interest company. I've never yet seen a question on this on the main part of the paper. But this is all about, you do want to make profits, but the profits are reinvested back into the community. So it's called a community interest company from there. And you have a cooperative, which is all about equal say and community, and everyone has a stake in that business. So it runs on a slightly different way. It's probably going to be pro-community, pro-worker, all the workers allowed to make decisions, big meetings held. So it's just a different way of running a business. Okay, get up here, a startup cost, running costs. How do you finance financial startup costs, which are the basis of the start of a business? You finance them by having a loan or shares, will be the two ways of doing it. Running costs, overdraft or trade credit on there. And then we moved on to, that is the end. Okay, thank you, bye.